Adani Ports and Special Economic Zones Limited is India's largest private port operator. Other than operating ports, it also has many other business lines such as trucks, other logistics services, trains, etc. So today we will analyze Adani Ports and Special Economic Zones Limited. We are going to analyze its revenue growth, EBITDA growth, then its aspirations for the future, its current balance sheet, and finally its discounted cash flows. Okay, free cash flows. We're going to calculate its free cash flows. So first, let's take a look. Market cap 2,87,871 crore rupees. So by market cap, this is a massive company. Price of one share is 1,332 rupees. Book value is 288 rupees. Book value is basically net asset value per share or equity of the company per share. So current price of one share is way more than the book value of one share. Return on equity of 18.8%. All right, pretty nice. Okay. Return on capital employed of only 13.8%. Hmm. And a price to earnings ratio of 25.3. Okay, so its market cap is 25.3 times its net profits. So let's take a look at its net profits. So here is its P and L, the company's profit and loss from 2014 all the way to 2025. All right. So we got multiple figures. We got sales, we got operating profit, we got profit before tax, and finally net profit. And the growth figures also, how much did they grow in percentage terms? So in 2014, we had sales of 4,830 crores. We had operating profit of 2,919 crores with an operating profit margin of 60%, an extremely high operating profit margin or OPM, which is characteristic of the ports business. It seems like when compared to its competitors, they seem to have this high operating profit margins. Like all the port companies seem to have this high operating profit margins. Net profit was 1,741 crores for 2014. Let's move a few years ahead. 2018, sales of 11,323 crores, 7,100 crores of EBITDA for operating profit, net profit of 3,600 crores. Okay, moving forward, let's go to 2022. 17,119 crores of sales, 9,528 crores of operating profit with a 56% operating profit margin and net profit of 4,900 crores. And finally, 2025, we have sales of 30,475 crores, around that figure, 18,000 crores worth of EBITDA or operating profit, 60% operating profit margin, and 11,000 crores worth of net pure profit. So sales, operating profit, and net profits all have risen noticeably. We can just see these figures, and we have seen that they have risen by quite a lot. So let's see the percentages. So the compounded sales growth, okay, the compounded sales growth, the CAGR for sales was 17% over the last 10 years, 21% over the last 5 years, last 3 years, 21%, and TTM, that is trailing 12 months. So sales growth compared of last 12 months. Sales growth last 12 months, 17%. And compounded profit growth has been 17% for the last 10 years, like per year 17% profit growth. Last 5 years has been 23%. Last 3 years has been 27%. And trailing 12 months or last 12 months, 19%. So profit growth has kept up with sales growth and in recent years outgrown sales growth. That's good to see. A stock price continuously rising for the last 10 years. Last year it declined. Of course, I invested this year. So of course it declined this year. I do own some shares of Adani Ports, so I can be biased. So beware of my commentary. Then return on equity. Return on equity 18% over the last 10 years. Okay, last 10 years ago, 18% was return on equity. 5 years ago, 17%. Last 3 years, 17%. Last year was around 19%, or we saw 18.8%. So pretty consistent return on equity. So these were the figures, okay? Nice sales growth, 17%, profit growth around 17%. Last 10 years, you're discussing. Return on equity also consistent. Last thing to see from here are cash flows, okay? Cash flows from operations. We don't have the growth figures here, but we can see they have risen substantially. So cash flow from operating activities, this represents the real cash made by the business, was 1100 crores in 2014, 2018 5600 crores, 2021 7500 crores, 2024 15,000 crores, and now 2025 17,226 crores worth of cash flow from operating activities. So along with revenue and EBITDA, cash flows of this company have actually increased massively. Only cash flow from operating activities. So these were the, let's say, the summary of financials. Now we will take a look into what this company actually does. All right. So Apsis, what is Apsis? Okay, at the topmost above me, Apsis, Adani Ports and Special Economic Zones Limited. It says is an integrated transport utility. Integrated transport utility. These words, these three letters, sorry, these three words say a lot, say a lot about the business, because here you can see, here you see all these things. We first have marine services, all right, we have ships and all. Then we see ports, trains and tracks, MMLPs, okay, logistic parks. These are like locations, basically locations where logistic services are provided, okay. It's a location where warehouses services are provided, like packaging services can be provided. It's a location where one type of transport, like road infrastructure, can be connected to another type of transport, like water infrastructure, waterways. So MMLPs are multi-modal logistic parks, then warehouses, then trucks. Adani Ports and Special Economic Zones Limited owns all of these assets, all of these different logistics way you can say. They own trains, they own tracks, they own the logistics parks, they own a lot of warehouses, they own ships. Their main business, ports, they own a lot of ports. They're India's biggest private port operator. They own trucks. They want to become an integrated transport utility. Basically, if you're a person who wants to transport stuff in India, okay, you want to transport some good, and you can go to Adani Port, and Adani Ports can get it done, can get that transportation done by trucks. They can store them in warehouses. They can send them to a multi-modal logistic park. In these parks, you can get, again, storage done. You can get some packaging. You can get packaging done. All right, you want to send them out of the country. Then you have trains. Okay, they have ports. You can send them to ports owned by Adani Ports. Okay, so here we see a lot of figures, and here it shows the company's high growth asset trajectory. Okay, high growth asset trajectory. Let me make this a bit smaller so we can actually see the dates. Okay, so few things have been compared. First, we have figures from fiscal year 2020. Okay, then we have figures from quarter one fiscal year 2026. And finally, very important, we have their targets for fiscal year 2029. All right. So first we have marine services. We have, okay, tugs and vessels. Tugs and vessels, kind of the same thing, only a technical difference, but okay. So in 2020, fiscal year 2023, 2020, the first thing we're discussing, 26 tugs or 26 vessels. Then in 2026, the first quarter, the latest quarter, okay, 118 vessels. And by 2029, they are targeting three times revenue growth. They're targeting three times revenue growth from this one thing, this marine services, these vessels and all, three times. All right. In 2020, they had 10 ports. Okay. In 2026, quarter one fiscal year 2026, fiscal year 2026, as of now, 19 ports. So almost double the ports. And by 2029, they are targeting 1 billion metric tons of cargo. Now, rakes, consider them as trains for this sake. 2020, 58 rakes, now 132 rakes, or basically trains. And by 2029, they're targeting 300 rakes. Okay, MMLPs, multi-modal logistic parks, more than doubled from 5 to 12 in 5 years. In the next 4 years, want to go to 20. Warehouses, zero point 0.4 million square feet in 2020, 2026, quarter one fiscal 2026, 3.1 million. They want to go to 20 million square feet worth of warehouses. Okay, 937 trucks they have right now. Okay, they didn't have this in 2020. So trucks, they introduced them in the last 5 years only. And 2029, they want to have 5,000 trucks. So they're massively expanding the assets that they have right. All right, massively expanding the assets. And by 2030, they want their domestic ports to handle 850 million metric tons worth of cargo. International ports, they also have international ports where they want them to handle 150 million metric tons by 2030. So, one good thing is that they have given estimates, they have given targets very clearly. So, we can judge management if they actually achieve these targets or not. Then, moving on, they are India's, oh, sorry. Yeah, they are India's largest private port operator with selective global presence. Okay. So currently they have operating 14 ports in India. In India, 14 ports handling a total capacity of 633 million metric tons. Okay. And here we have the capacities in West Coast, the highest. Then we have East Coast capacity, and then we have South Coast capacity. So throughout India, all the coast of India are covered. And the largest is Mundra, of course. If you see Mundra, Mundra handles the Mundra port is the biggest and most important asset. Mundra port handles 264 million metric tons out of this 633 million metric tons. So you can understand how important Mundra port is, handling like one third, more than one third of the entire like cargo capacity. Then in international ports, they have four of them. Okay. One is in Israel, one is in Tanzania, one is in Sri Lanka, and one is in Australia. All right. Now, this is important. Logistics and marine services. These two segments, logistic services and marine services, we can consider them as their like future growth trajectory. So majority of the growth or a significant portion of the growth, Adani Port's future growth will come from logistic services and marine services. So in logistic services, first we have the multi-modal, multimodal logistic parks. Why are they called multimodal? Because they're connecting or they're integrating different modes of transportation, like railways, roadways, air cargo, waterways. They're connecting all of these through these parks, and they are present near key industrial regions. They have 3.1 million square feet of warehouses, 1.3 million metric tons of capacity of agri silos. What are agri silos? Basically, we have a farm, and farm we have these cylindrical containers in which you can store agricultural material inside them. That's it. Storing agricultural material inside these things. All right, inside these cylindrical containers. So these are agri silos. So these agri silos, 1.3 million metric tons of capacity. So they can store agricultural material inside them to transport them. So another service they can provide is capacity for storing agricultural material. Then 68 container rakes again, kind of like trains, seven agri rakes, okay, three after rakes designed for car transportation services. Okay, car transportation services they also have, and they own and manage a fleet of 25,000 plus trucks. More importantly, they're estimating logistics revenue to grow five times, to grow by 500% by fiscal year 2029. So we have like what? 3 to 4 years, 3 years, five times they have to grow revenue. They're estimating growing revenue to 14,000 crores from 2,800 crores in fiscal year 2025. So crazy growth. Okay, crazy. 14,000 crores. The total revenue for this year is around 30,000 crores. In the next 3 years, 4 years, They want logistics to grow by 2,800 crores. And we already saw that. They're massively increasing their trucks, their container rakes, and especially warehouses and multimodal logistics. Then marine services. Now, in the marine services business, all right, they have acquired multiple companies. Here we have Ocean Sparkle Limited, we have Tahid, then we have Astro Offshore. Okay. And by fiscal year 2027, they want revenue to grow by 3x. So in the next year or two, they want revenue in this segment to grow by 300%. All right. All right. Um, Compared to fiscal year 2025. Okay. 300%. And if you're wondering what this means, MESA region, MESA, they have actually, I think, given this. MESA refers to Middle East, Africa, South Asia. All right. All right. All right. So these are the marine services. Here you can see what kind of ships they have. Okay, tugs, AHTS. Here they given the definition. Anchor handling tug supply vessel. All right, we have MSPs, MPSV, multi-purpose support vessels, workboats, and top flat top barges. That looks pretty good. So marine vessels, marine services. The different types of marine services, you can search them out. They can Google can explain way better than I can. But three times revenue growth is the main thing to see here. Then moving on, we come to their debt position. How's their debt looking at? Okay. So first, we can compare net debt to EBITDA. Net debt to EBITDA. So in 2021, the net debt, that is total debt minus cash and cash equivalents, was 3.3 times EBITDA. Then 2023, 3.1 times EBITDA. And in quarter one, fiscal year 2026 is 1.8 times EBITDA. The lower this figure, the way better it is. Okay. Then here we come the net debt, the gross debt, and the average maturity. Let's come to June figures. So as of June fiscal year 2026 or June 2025, their total gross debt was 53,089 crores. The net debt is only 36,168 crores, not only massive figure. So they have around something, not 20,000, 17,000 crores worth of cash and cash equivalents. And the average maturity of this debt is around 5 years. 5 years. Okay, 5 years the average maturity. Um, all right. Debt levels have increased, but not that massively. And okay. Then FFO upon gross debt. Okay, FFO as a percentage of gross debt. You're wondering what FFO means? Okay, FFO means funds from operations. Funds from operations, as the name suggests, the cash generated from operations. You can see the formula, EBITDA minus interest plus tax paid in cash plus interest and dividends received in cash. The word cash has been used, funds from operations, basically the cash, real cash, not just net profits written on an accounting sheet. No, real cash generated by the funds, the company's like operating activities. So as a percentage of gross debt, this has increased. Okay, 22% in fiscal 2021, then reached a high of 34% in fiscal year 2025, and right now 30% for quarter one fiscal 2026. The higher this percentage, the better, but it is rising, so that's a good thing. We only have for the last 5 years, only shown for the last 5 years. That's something to look forward to. Then funds from operations upon interest they pay on loans. This is pretty important because it shows how easily they can actually pay interest. The higher this ratio, the better. So right now, this number is rising, which is a good thing. Which is a good thing. You can see the rise, and currently, this quarter at least, it was 7 times. Funds from operations are 7 times the interest that they have to pay. So overall, debt situation, they have debt. Of course, they have debt, but all right, it seems to be getting better. The funds, the cash they're generating seems to be going better than the debt. So they can debt servicing, paying back the debt is now easier than it was before, though before it wasn't really an issue. Then business line wise return on capital employed. Okay, return on capital employed. As a company as a whole, consolidated 15%, okay, return capital employed as a whole has been increasing for the last 2 years compared to last 2 years from 12% to 13% to now 15%. Return capital employed for domestic ports has increased massively, around 21%. Higher return on capital employed, the better. Marine services, okay, 13% is the return on capital employed. In international ports, only 6%, and logistics, only 6%. And they're expecting that in the next 3 to 4 years, these businesses will achieve threshold return on capital employed. Threshold return capital employed is the minimum rate of return on capital, okay, the minimum rate of return on capital by which no loss will be there. If all the money they have spent, it will be recovered and they can finally make some profit. That's the return on capital employed. So costs will be covered and they can make some profit. The threshold return on capital employed means that. Then what else do we have to do? I forgot. Yeah, we had to do this only. Domestic ports, we saw return capital employed been increasing. First, we have Mundra. Okay. Here you can see the dark blue represents fiscal 2025. The lighter one represents 24, and the lightest is 23. 36% for the largest port, Mundra, return capital employed has been increasing. Hazira port, the Dahej port, highest 32. And we have a bunch of other ports also. Jesus. Gangavaram declined from 11% to 4%. I think Gangavaram had some accident or something, like some external accident happened at Gangavaram. I'm not sure, but I have to check. I think they mentioned this in the con call, so I can maybe bring that up one more day. Okay. Then, outgrowing the competition. What this company has done, it has outgrown the competition quite a lot. All right. So, Apses has delivered consistent growth in the past and continues to guides to continue to do for in the future. Now, this is impressive. So, first, we can see this figure in the container share market. Container market. What is container market? Okay, Apsis has a market share of 46% in the container market of India. So containers, all the goods, going to the ports, all the goods handled by ports in containers. Okay, all of the goods handled by Indian ports, which are in containers. So all the goods in containers being handled by Indian ports, 46% of those all those containers are handled through owned by Adani ports. And this share has increased substantially from 36% around 5 years back to now 46%. And when talking about overall cargo, that is what is overall cargo. Overall cargo includes bulk cargo, it includes containers like goods in containers, also includes stuff like liquids and gases. Because like we need to transport liquids and gases through ocean also, like oil has to be transported, right? So in the overall cargo, they have a 27% market share. Okay. You can see this market share is expanded massively. In 2013, 2012 was 10%. You can see in 2002, it was like, what was it? Like 1%, 1% maybe, but now 27%. And you can see that in overall cargoes, this figure shows cargoes. The market share is increased so rapidly, it means that they're outgrowing the competition by a massive margin. So 27% of all cargoes handled by ports in India, it's done by them. 46% of all containers handled by ports is done by them. All right. And here you can see all India cargo and Apsys domestic cargo. For the last 10 years, all India cargo in million metric tons has increased only by 4% year on year, annualized growth. While Apsys, their growth in the domestic cargo volumes has been around 12%. They have 3x the growth, 3x the industry in terms of growth. They've outgrown massively and they're targeting 850 million metric tons of domestic cargo. Okay, domestic cargo. By international, they are targeting 150 million metric tons. In all, they want to manage 1 billion metric tons in like cargo. Okay. And currently they have around 637 million metric tons for domestic, and they're targeting 850. So they have shown they have grown a lot. And now these are projections. All of these are projections for the next so many years. Good analysis, so many years. Next 4 years, they're targeting 45 to 50,000 crores of capex, capital expenditure in domestic ports, 15 to 20,000 crores in logistics, and technology capex plus decarbonization. I think that's around 5,000 crores of capex. So 80,000 crores of capex, around 80,000 crores of capex over the next 4 years. So massive capex. Now, will they fund this through debt, or will this fund this through their own cash that they generate from their company? Uh, it's mentioned in the con call. I have a video on the con call highlights. You can check it out. Okay. Con call highlight. Adani Ports con call highlights. Then the revenue projections. So in billions, okay, billions. So in 2019, revenue was 10,000 crores. 2025, 31,000 crores. By 2029, fiscal year 2029, we have 4 years. No, we have like 3 years, around 3 years. 3 years, some months. They expect revenue to grow by 20% CAGR to 65,000 crores worth of revenue. 65,000. Okay, ambitious. And EBITDA, they expect it to increase by 18% year on year to 36,000 crores EBITDA. This figure is more than the current revenue, by the way. And how are they projecting it? Driven by market share expansion, capturing more of the market, prudent capital allocation. All right. And net cash flow from operations, they expect it to rise by 19% over the next 4 years to 34,000 crores of cash flow from operations. Ambitious. This figure is also bigger than the current revenue. All right. And I think lastly, for fiscal year 2026, this is the guidance given by, or the target given by management. They expect to have 36 to 38,000 crores of revenue, 21 to 22,000 crores of EBITDA, 11 to 12,000 crores of capex, and net debt to EBITDA up to 2.5. Oh, it's elevated. I think it was 1.8. Okay, so I think they're taking on more debt, it means. All right, they're taking on more debt. They expect the port cargo volumes to be 505 to 515 million metric tons. Trucking revenue will grow 3 times to 4 times, around 428. Okay, 3 times to 4 times, 428 crores. So 1,200 to 1,600 crores of trucking revenue. Marine revenue will grow by twice. Twice of what? 1,144 crores. So 2,288 crores, like that. And marine revenue is forecasted to increase to over 3,300 crores in fiscal 2027. Okay, very, very aggressive growth. So this was Adani Ports, a company which started with ports and is now gone into logistics, truckings, logistic parks, trains, international ports. This company has outgrown the competition by a lot. It has shown significant profit plus revenue growth. Its focus is currently a lot on logistics and marine services as future growth drivers, and also, of course, expanding their current important business, which is ports. Ports provide the majority of their revenue also. And here you can see the projections are also very impressive. And finally, we will have the free cash flow of this company, which I have calculated and might be a bit misleading. So here we have the free cash flow. Okay, we have the cash flow from operations taken from screener. We have the interest. Now, interest for loans I've included because I think calculating cash flow, interest is actually not included in cash flow from operations. It's excluded because of some accounting rules. And maintenance capex, it's the capital expenditure for maintaining the assets. Okay, not expanding your assets. Like you have one building, you expand into two buildings. So you need to incur a lot of capex for the second building. No, maintenance capex, the capex required for that building, right? The existing one building you have, let's say to completely renovate it. Maintenance capex is a significant long-term investment. It's not like day-to-day upkeep. Like in a building, hypothetical example, there came a small crack. Okay, a pipe in the building is not functioning, so there will be a day-to-day repairs. That will be operational capex. Maintenance capex is a significant investment, long-term investment, ensuring that the asset that you have, it maintains its operationability, it maintains its efficiency. Maintenance capex. I could not find exact figures, and so I took depreciation as a proxy. So in these maintenance capex, it's mostly depreciation because again the company has grown so much, they're investing a lot in expanding the asset base. That's growth capex. So I need to find the maintenance capex. That's why I took depreciation as a proxy. And here we have the free cash flow. So 970 crores in 2015, 2018, 2800 crores, 2021, 3100 crores, 2023, 6112 crores, 2025, 10,315 crores. All these figures are in crores of rupees. So massive growth in free cash flow. The free cash flow yield, okay, here, free cash flow yield, um, which is free cash flow as a percentage of market cap. It changes because the market cap changes around 3.6%, which is not the worst. It's all rightish free cash flow yield, but the growth has been impressive. Last 10 years, annualized growth for free cash flow has been 26.6%. Last 5 years, 22.2%. Last 3 years, 29.5%. And okay, yeah, yeah. So great free cash flow, if only if this maintenance capex, where we are taking depreciation as maintenance capex, even though it's a non-cash expense, but because they have been expanding assets so rapidly, they're growing so rapidly, a lot of their actual like expenditure on purchasing power plants and equipment PPE, which we usually use for maintenance capex, that has been mostly growth capex, expanding more and having more and more assets. So that's why maintenance capex, I use depreciation as a proxy. It could be inaccurate, and but okay, impressive growth, uh, decent free cash flow yield. I own some of the shares. Of course, I'm down. And this is not financial advice. I'm not registered by SEBI, nor will ever be. So that's it. Watch the Adani port con call highlights on this channel.